Welcome to the world of managerial accounting, where you will be transitioning from the financial accounting world of the previous units 1 through 6, and we're now going to turn inwards to the organization and figure out how the managerial accountants within the company think about and analyze what's going on within the organization. And the job of management accountants is to look for internal efficiencies, effectiveness. Something like the balanced scorecard comes from the field of management accounting. And so it's that internal, what gets measured gets done philosophy. And it also has very, very different approaches than financial accounting. A good example of the difference between financial accounting and managerial accounting is contribution margin versus gross margin, which you saw in the text if you've read through chapter 2. The management accounting, we want to look at contribution margin, which is sales minus variable costs, whereas in financial accounting, we talk about gross margin. And you've seen gross margin in the financial statements for TELUS and in the samples and all the work that you've been doing within the text. Contribution margin is different. Contribution margin, we're really looking at, okay, what is the incremental benefit of selling a product, and how does that help us cover the fixed costs of both creating the product but also of selling the product and marketing the product. So we really want to figure out, do we have to sell a lot of these? Do we have to sell a few of these? How much difference does it make in pricing if we just increase the price by $1 or drop the price by 50 cents but get a higher volume? What does that mean? What if we are able to save $1 in costs? And so contribution margin analysis is an important tool in management accounting. So in terms of management accounting, I just wanted you to be aware of this as a discipline, get to know the terminology within Chapter 2, and have some sense for how the manufacturing world has used, and merchandising, has used management accounting. It does translate into service companies, and you've seen that in your balance scorecard and how your balance scorecard works. So it is used there, and we can draw on the very deep discipline of manufacturing management accounting and apply that within services. Some of the ways that you've seen it working in the merchandising area are things like this cost volume profit analysis, right? What is the break even? So the idea of, okay, if we're paying this much for a handset and we sell it for X, what does that mean as far as the number of units we have to sell to break even on that particular model? Do we even carry that model, right? That's a basic break even analysis, which is part of management accounting. It also is helpful when you're looking at supply chain management and thinking about your different pieces of the puzzle in supply chain management, because you'll want to look at things like contribution margin of your suppliers, as well as for yourself as a merchandising company, that part of the business, thinking about how you manage that inventory levels and make decisions on pricing, make decisions on supplier costing and which supplier to go with. So it's all related to profitability ultimately, but more importantly cash flow, and that is the field of management accounting in a nutshell. Let's walk through self-study question number 4 just to demonstrate the high-low approach to variable versus fixed, so that you're super clear on that and have the ability to use that when you are doing any sort of analysis within your organization. So the high-low, at Kendra Corporation, we've basically got some information about the costs, the high and the low cost per month, and we have the high and the low units of production. So we know the high cost is 1,200 for the highest month, 600 for the lowest month, and the units of production are a high of 10,000 units per month and a low of 2,000 units per month. And our first step in calculating the high-low method is to take the difference in cost between high and low, 1,200 minus 600, and the change in cost therefore is $600. And that gives us our base from which we will calculate our variable costs. Step 2 is then to calculate those variable costs. And what we want to do when we calculate the variable costs is take that change in total costs of $600 that we've just calculated, and we want to divide that by the high minus the low units. So in this case, that will be 10,000 minus 2,000 units. So we're going to take $600 divided by 8,000 units, and that's going to give us an answer of 0.075 per unit. And so that is our variable cost piece of our utilities. Once that's been calculated, our final step is to calculate the fixed costs. So fixed costs are calculated by taking the total cost at the high end, which is 1200, and then subtracting the variable cost per unit that we've just calculated in step 2, that 0.075 number, times our high volume of 10,000 units to figure out what the chunk of changes, in this case $450, that relates to the fixed cost base. So again, it's taking that high $1,200 total costs, right, minus 0.075 times 10,000, in brackets those last two numbers, right? And then figuring out what the total fixed cost base is, which in this case is $450. So that puts you in good shape for the first part of the assignment, which is basically a terminology question number 1 and a high-low calculation for question 2. And then the next video will be a review of chapter 11 and a walkthrough of a manufacturing overhead statement.